I know that these are scary times for investors. The headlines that you read over and over again or you see on the nightly news talk about war, recession, and the reality of inflation. So as an investor, I wanted to take these one by one and address them in the context of, given today's headlines, what's an investor to do? And how are you to stay focused on the future? You know, when you originally define and create your portfolio, I'm sure you had conversations about volatility with your advisor / coach. The reality is, talking about inflation and having to live through it, talking about war and having to live through it, talking about recessions and having to actually live through it and not panic are two different things. Nothing is more unsettling, I believe, than the prospect of war for investors. And we all know that there is a war going on in Europe with Russia attacking without provocation a fellow nation, Ukraine. And we see it every single day, the horrendous and terrible realities of the massacres that are going on in that country and their ability to try to defend themselves against Putin. But what's that mean to your portfolio? As horrific as it is, it would be a mistake if you equated the fighting in Ukraine with an absolute certainty that the market is going down. Why is that the case? Well, markets are efficient, meaning that they're forward-looking, meaning that all the knowable and predictable information about the future is factored into prices today. Therefore, only unknowable and unpredictable information going forward will affect prices. Let me give you an extreme example. Let's go back in history almost 80 years ago to World War II. If you had known in advance all the headlines, if you had a crystal ball, and you knew how terrible and destructive and painful and the loss of life, property, liberty, and destruction, what would you have guessed the markets would have done? I'm going to say that you would have guessed almost certainly that markets would have gone down. In reality, if we look at the S&P during this whole period of time, from 9/1/1939 to 8/31/1945, we see that the US market, as measured by the S&P, was up over 12% per year. If we look at all the stocks available on the US market, as measured by the CRSP index, which stands for Center for Research and Security Pricing at the University of Chicago, nearly 13% per year during this horrendous time. So there's one thing that I want you to remember moving forward. No one can tell you, and this doesn't matter if there's war or other factors, extenuating factors, circumstances about life. No one can tell you where the next 20% movement in the US market is going to be. And if they are, they're either delusional or they're trying to mislead you on purpose. No one can tell you where the next 20% is going to be. But what we do know is historically, the next 100% of the market is up. And it's been that way through wars, recessions, depressions, external threats and internal threats. Someone asked me just the other day, what would happen if there was war and attacks on our own country inside of our own borders? To which I answered, that's already happened. It happened on 9/11. Our country was under attack by terrorists. So even that's already happened. And we know with retrospect that after this horrendous event, that America went on the aggressive and that we actually caught many of the terrorists that perpetrated this heinous crime against us. Markets recovered. But what about Pearl Harbor? If I go back and I look at Pearl Harbor, if I look at, for example, 12/1/1941, after Pearl Harbor, to 8/31/1945, after America entered World War II, we can see that the annualized rate of return, get this now, the annualized rate of return of 21.8% annualized per year for the S&P. If I look at the CRSP index, 21%, 21.18% during that period of time. So here's the bottom line, as afraid as you might be, no one can tell you anything specifically about the outcome of this war. Many people will speculate. But as an investor, planning for your retirement and planning for your family's dreams, it is critical to take the long view and to focus on what you can control, which is your discipline and your courage over time and your dedication to your design of your academically tested portfolio. And then somehow, I know it's not easy, somehow let go of the things that you can't control. If you look at throughout your own life and through history itself, you'll see that it didn't come to stay, it actually came to pass. And this too shall pass in time. It will be the investors that stay disciplined and have the courage and the fortuitiveness not to panic. You know, as an investor, it is never the right time to panic. And if equity prices do go lower, as they tend to do over time, we know that historically investors who stayed disciplined and sold off their fixed income while it's high and bought more equities while it was low had a longer term expected return. Why? Because when markets are lower and there is fear in the market or fear in the world itself, equities go lower to price in a higher long-term premium. So the people that are smart enough, brave enough, and wise enough to actually buy things when they're down historically fare much better than the people that panic when they drop. But we're not dealing with just war. We're also dealing with recessions. And it would be easy to think we have right now, as of this filming, this taping of this, we have 2 quarters in a row of negative returns. Our last quarter was negative 1.4% in the United States for the restriction, the contraction, if you will, of the US market. And if we do hit one more quarter, it will be officially a recession. What's history tell us about recession? It would be easy as an investor to think that there was a high correlation about recessions and negative or down markets. But a student of markets and a student of history will actually see that markets tend to go down before the recession and often actually go up in the middle of a recession. So there appears to be little to no correlation between a recession and what the markets are doing in that period in which the economy is actually contracting. It would be nice to know, wouldn't it, when there was going to be a recession or when there was going to be a depression or when there was going to be economic turmoil. We can look throughout history. This company has been in existence since 1991, and we've seen 3 major impacts that investors who were courageous and patient and disciplined in the end prevailed. The first of these was the dot-com crash. The year was 2000, over 20 years ago, and the S&P and large stocks had made unbelievable rates of returns from 1995 to 2000. The S&P had made in the ballpark of 22% a year. NASDAQ type stocks made 45% a year for 5 years in a row, and everyone was feeling bulletproof. What happened after that was a terrible debacle. US stocks, US large stocks dropped over 50%, and NASDAQ stocks would drop over 75%. And then what would ensue would be what many people would call the dead decade, a decade in which large US stocks actually had negative returns over a full 10-year period. We've been telling investors, warning investors about the dangers of loading up on only 1 or 2 asset categories. And historically, over the last year, we've seen them double down on both US large stocks or S&P 500 stocks and NASDAQ type stocks. What's been the effect this year? Well, let's just say less than stellar results. The NASDAQ is down so far year to date. This filming is May 10th. As of yesterday, May 9th, the S&P was down 15% year to date. And the NASDAQ was down 25% year to date. Those same companies that seem bulletproof as of up to last year seem to lose over a quarter of their value in less than half a year. How do you protect yourself from that? The way that you protect yourself through that is diversification. You don't just own large stocks. You don't just own NASDAQ type stocks, the ones that tend to be in the news every day. You actually globally diversify and focus on owning both small and small value stocks to help reduce the risk and the uncertainty. For example, the NASDAQ is down 25% as of yesterday. But if I look at the Russell 1000, these are large US value stocks. They're only down 8% as of yesterday. If I look at international large value stocks, they're down only 8% versus the NASDAQ down at 25%. Diversification, global diversification is critical during these times. And what about inflation? So far year to date, inflation is clocked in, CPI at over 8.5%, the highest it's been in over 4 decades. It would be easy to see the triple threat of war, recession, and inflation as a warning sign to get out of the market. This would be a terrible mistake. It's called market time. And one thing academics show us over and over again, people tend to panic and sell things when they're low, and they tend to get greedy and want to buy things when they're high, which is the exact opposite of what academic study tells us to do. It actually tells us to sell those things that are relatively high, which right now are short-term, high-quality fixed income, and buy more of the things that are low through a rebalancing process. And that's exactly what we are going to do here at Matson Money. Many of you are wondering or thinking, I'm afraid. What should I do about that? One thing I want you to know is that when you turn on the TV and you go to watch the news, cable news programs, they are not your friend. They are not there to educate you. They're not there to help you stay disciplined over time. They're not there to help you deal with fear or anxiety in a positive way. As a matter of fact, to a large extent, they exacerbate fear and anxiety because it's profitable for them. If you're focused on the terrible negative things in the world right now, then they will get more eyeballs, and those eyeballs will end up creating more viewers, and those viewers will create higher profits when they run ads for whatever products they're selling at that time. Don't fall for it. I know it's hard, but you want to focus on the positive. When everything's uncertain, anything is possible. And we've been through tough times before. If you remember Reagan and the Cold War, you'll remember Russia having taken over much more of Europe than it has today. But there are always brave, courageous people that are willing to stand up to evil, corrupt people. And I believe this is part of the human condition. If you're worried about inflation, historically, the best way to overcome inflation has been through owning equities. Historically, inflation is clocked in at about 3%, and the S&P, large US stocks index, clocks in at about 10%. So you're looking at almost a 7% premium per year, real return over inflation. Small value stocks historically, through all the data that we have shown up and clicked in at about 14% versus a 3% inflation rate. No one knows what those exact rates will be going forward, but if you're planning for your retirement and you're planning for those golden years and you're planning for all your dreams that you have, one thing's for sure, inflation will be something that you'll want to not only keep up with, but historically something that you would want to do better than. And so for investors concerned about inflation, equities provide an amazing hedge long-term against the risk of inflation. Every investor, big or small, must deal with one thing that no one else can deal with, and that is their own mindset. Because investing will never be easy. Investing may be one of the most difficult things you'll ever do because it entails being able to do a journey into self and recognizing when fear, instincts, and blind spots cause imprudent behavior that can actually destroy your dreams. I'm aware of all the negative things, headlines, and all the negative economic reports that are coming out today. And I still understand the economics and the academics of investing. In the long run, they're really quite simple. Own equities, diversify, and rebalance. Easy to say, hard to do. The human brain itself is not hardwired for these activities. As a matter of fact, our brain is very great at running away from saber-toothed tigers, but when the amygdala gets hijacked and gets lit up because of stress, anger, and fear, it's easy to overreact and do the wrong things. In nature, there's 3 responses typical when there's high degrees of anxiety, stress, and fear. Number 1 is to run. Number 2 is to fight. And number 3 is to actually play dead. When it comes to investing, every single one of these strategies are destructive. And that's why it's critical that you work with your coach. Your coach is your secret weapon against your amygdala, your instincts, and your emotions taking over and causing you to have destructive behaviors going forward. So understand that your portfolio was constructed so no matter what set of circumstances, it would put you in the best position to maximize your returns for any given level of risk. And the portfolio was created without specifically a prediction about the future, because that is the greatest folly of all. The reality is no one knows what will happen in the future. They don't know what the good things that will happen in the future. They definitely don't know what bad things will happen in the future. And the market has already factored all of that into the prices today. And I'll leave you with one thought that is comforting to me. And that is the indomitable nature of human beings. If you look throughout history, there have always been periods of chaos, fear, pain, and struggle. But they were always followed by peace, tranquility, bravery, and courage in the face of fear. And I am confident that given enough time, we will see the same outcome in this situation. Stay disciplined, focus on what you can control, meet with your coach, and whatever you do, don't panic. Thank you.